everyone, welcome back to the channel. Today, we're diving into another stock that's been quietly slipping over the past few months, Jindal Saw Limited. This company was once a strong performer in the metal and pipe segment, but recently, the stock has lost a lot of steam, falling close to its 52-week low. We'll break down what's happening with the stock, the recent financial results, and what investors should watch for in the coming quarters. And as always, this is not a buy or sell recommendation. It's purely for educational and analysis purposes only. Let's start with a quick look at where Jindal Saw stands right now. As of mid-October 2025, the stock is trading around 190 per share, which is just above its 52-week low of 189.5 and far below its 52-week high of 378. That's a massive 32% drop over the past 1 year. And if you look closer, the stock is down almost 29% in the last 6 months, and another 7% just in the last week. So clearly, there's been a consistent downtrend, and the stock is now underperforming both the Sensex and the overall metal sector. Now, let's talk about the numbers, and this is where the real story lies. In the latest Q2 FY26 results, Jindal Saw reported a sharp drop in both revenue and profit. The company's net profit declined nearly 70% year-on-year, indicating serious pressure on margins and operational efficiency. EBITDA and overall margins have also shrunk significantly, suggesting that input costs and operating expenses have been hurting performance. This kind of margin squeeze often happens when raw material costs rise faster than the company can pass them on to customers. And that seems to be exactly what's happening here. Despite that, Jindal Saw still remains a large-cap, sector-leading player, with a market capitalization of around 12,000 crore. Jindal Saw is one of India's largest manufacturers of iron and steel pipes, supplying to oil and gas, water infrastructure, and construction sectors. However, the company has been facing weak demand in export markets, along with pricing competition and higher energy costs at home. While these are cyclical challenges, the underlying infrastructure story in India, especially in oil, water, and gas transmission, still offers long-term growth potential once demand revives. So the business itself isn't broken, it's just going through a tough phase in the current economic cycle. Investor sentiment has understandably turned cautious. The stock's recent fall reflects pessimism around near-term growth and margin recovery. Institutional interest has also softened a bit, though the company continues to maintain a manageable debt profile and a reasonably strong balance sheet. Valuations right now look moderate, but without signs of earnings stabilization, there's little room for a re-rating in the short term. So what's the way forward? In the short term, Jindal Saw may continue to remain weak until we see signs of margin improvement or order inflow recovery. Any bounce will likely be technical in nature rather than fundamental. In the long term, say 1 to 3 years, if the company manages to control costs and capitalize on new infrastructure projects, it could emerge as a turnaround candidate when the steel and pipe cycle improves. But patience is key. This is a cyclical stock, and investors need to wait for the next earnings cycle to confirm recovery. So to sum it up, Jindal Saw is in a correction phase after a strong run in previous years. Revenue pressure, cost headwinds, and weak market sentiment are weighing on the price. However, being a sector leader with strong scale, it could bounce back when the industrial and infra cycle picks up again. That's all for today's analysis. If you found this breakdown useful, don't forget to like, share, and subscribe for more such insightful stock updates. Thanks for watching, and I'll see you in the next one.